All right, Happy New Year, Karl Denninger, again here with me at MissTrade, Matt Davio. And Karl, I was reading your blog this morning, and you had some thoughts and ideas on 2010, as Eric likes to do. 10.
Yep.
So why don't you recap those? Tell me a little bit about where you think we're heading here in 2010 after a big monster 70% rally off the bottom.
Well, the biggest issue that I have with 2010 as an outlook forward is that we didn't fix anything in 2009. We claim to have done a whole bunch of things to help the economy, to help the banking system, and really what we did was hand out several $1 trillion worth of credit and money to the banks, and essentially none of that has shown up in the broader economy in terms of credit availability for small businesses and individual consumers. And it can't, and it's not that they didn't want it to go there. I mean, clearly the intent was you give this money to the banks, they will lend. The problem with doing that is there's no collateral against which to borrow, and so the people who are solvent have no reason to borrow, and the people who are insolvent would love to borrow, but nobody in their right mind would lend them anything.
Right.
So you haven't fixed the overhang in the general economy. What you've done is maintain the leverage, and you've attempted to supplant consumer credit growth and business credit growth with federal government credit growth. Now we have the Federal Reserve saying they're going to pull back on that. We have seen long-end rates back up about 30% in the last month. That's not a very constructive thing for the economy and for the markets in the longer term. In fact, it's the sort of thing that happened in 1987, 6 or 7 months before you know what occurred then in October. So my concern in the coming year is we've had a huge rally that's not supported by the fundamentals of the economy and of the underlying environment within the markets. We've seen the credit markets attempt to return to irrational exuberance, the issue of pick toggle bonds and stuff like this, financing that was absolutely unsupportable 2-3 years ago and still is, and yet they're trying to get out there and push it again and make their money and take their bonuses. And unfortunately, we haven't fixed anything. So I see the potential for a push higher, maybe up to around 1220 sometime in the first few months of the year. But, the problem is you're playing on borrowed time here, okay? So you're looking at this from a standpoint of the technical trader. You would look at this market and you'd say, well, we could go to 1220, which is the 61.8 retrace of the entire dive. From a fundamental perspective, you say the 70% rally was unsupportable to begin with.
Right.
When it ends, it may go straight down instead of kind of leveling off.
Right.
So, and then I look at the withdrawal of that credit support, and I start getting pretty worried.
Yeah. Well, it was interesting. The couple points I'll throw out also because we're on the same page in a lot of this. Tradability-wise, we're in a tough spot. I think if I'm forced to give you a early part of the year call, I think 1,000 to 1,250 is kind of where we'll be. I don't think we'll break out of that range, and maybe that's the intent of all this money is to buy more time and not really necessarily go too much higher. And if we hit 1,250, that's 10%. If we hit to the upside, if we hit 1,000, that's 10% to the downside. So that's right where we are at 1130 here on the S&P. And you've got, as you said, 10-year rates have been rising. The dollar's been recovering. 10-year rates are pushing to that 4 level, which has been kind of a ceiling for us over the past 2 years. So I think we're going to have a hard time getting by that just because of what the monetary and fiscal policies are trying to prevent that. And even if we got above that, you've got more resistance there at 5% on the 10-year. So, which isn't necessarily that scary, but I mean, this market's not scared by it apparently. I mean, they're not scared too much by running to 4%. So I find it interesting.
I think you ought to look. Yeah, I think you ought to look at the TYX, the 30-year rate.
Yeah.
There's an inverted head and shoulders pattern that's about 2 years old on that. The first level completed, and then it immediately completed the second level pattern, the larger pattern that on the weekly is evident. That targets a 30-year rate up near 7.
Yeah. I agree. You're right, because actually, you've been seeing, I've been short the ZN bond, and it's been a good trade. But and some of my members have been short the ZB bond, which is the 30-year, and that
right.
has been a better trade. So it's interesting. You're absolutely right, and that's a great valid point that you're bringing up, that the 30-year may be more telling than the 10-year, which traditionally is more telling.
Well, I think that the danger is that you're getting into the area now where the risk of intervention is starting to go up dramatically. Okay, I mean, Bernanke and his pals can read the same charts I can read, and that you can read, and that everybody else can read.
Right.
They certainly know what happens if the cost of 30-year money goes to 70%, or goes to 7%. Take another 25% off the price of every house in America.
Right.
So that's not a surprise. The question is, what will they try to do to stop it after they have formally said that they're backing off on all of these gains?
Right. I agree. And then,
I don't know the answer.
Yeah, I don't have the answer either, and I think the pressure also is coming from the price inflation that you're seeing in commodities. Oil's back up new highs for the last 13, 14 months here today, pushing $83 a barrel, and I think whether that's real or whether that's a bounce back to a key resistance line in the $100 range probably is likely also. So,
well. Oil just broke a pennant today. I have a price target on it with that break up to 100, assuming that the break holds.
Right.
So, I mean, if people want to get long oil, this is the opportunity to do it. You put your stop back inside the pennant. You have a very limited amount of risk involved in that trade, but if it goes the right way, you're going to make a ton of money. Of course, that drives gas back up into the $3.50, $4 a gallon area, and that's not going to help the economy either.
Well, what do you mean? I was just in California over the holiday, the New Year holiday, and it was already $3.40 for the premium, it was $3.15 for the cheap. So we're already there, and we haven't even seen the $100 oil. So did we actually? But anyways, well, again, a lot of good stuff, a lot of food for thought here as we come into 2010, and we'll continue to ping you regularly because this is going to be a very interesting game, I think, 2010, and one that we want to stay on top of.
Yeah, I think 2010, your best definition 2010 is that we're going to find out whether or not the big suck is real.
Right.
And I suspect the answer to that is yes, that we've got too many things that are out there. The commercial real estate problem is still there. We haven't fixed it. You're going to see the residential market come apart in a way that we haven't seen before. The foreclosures are going to really start to hit along with the deed and lose and the short sales. You've got a backing up rate environment, which is not positive for either of those either of those subsets of the marketplace.
Right.
And you have a equity market that is levitating and expecting $80 in S&P earnings over the next 12 months. I don't see $80 coming in S&P earnings. I mean, the valuations are reasonable if it happens, but I don't see it.
Right. I agree. It's a tough time. Well, Karl, let's continue this conversation maybe once a week. We'll be back here next week. We'll ping you again. I appreciate you coming on, and let's see if this is for real, or as you said, the real estate and the interest rates, everything start to put pressure on those that are trying to manipulate the game.
You got it. Thank you.
Okay. Peace.